Welcome back. Markets this morning are rallying. We're about an hour away from the opening bell. Take a look. Dow Industrials up 279 right now, 0.5%. S&P 500 up 23, and the Nasdaq up 96 as investors are showing confidence in the president's leadership in this war. Have been for the last 2 weeks, although we're also watching earnings. Oil prices this morning are lower. Take a look. The price of crude down 1/3% at 89.30. VP J.D. Vance headed to Pakistan today for a second round of U.S. Iran peace talks, just ahead of the ceasefire expiring tomorrow. The president told me the U.S. is, quote, dominating and that he believes the war is close to ending. The president expecting Iran to sign the agreement tonight at hand, including terms that would prevent it from obtaining a nuclear weapon. The president told me that on Sunday. He is also warning, however, that if they do not sign tonight, the U.S. is prepared to finish the job by targeting critical infrastructure. Joining me now is MacroMavens President Stephanie Pomboy. Stephanie, good to see you. Give us your take on the market's response to this war.
Well, I think, understandably, the response has been related to the sharp drop in oil prices on the idea that now the big risk is behind us. And I think there's certainly quite likely that those prices will continue to come down if and when the final agreement is signed here and we come to an actual clear conclusion to this engagement. However, I would note that the trajectory of oil prices, even before the Iran action occurred, was higher due in no small part to this massive boom in CapEx related to AI and the demands for energy around that. So while I do think that we'll continue to see some relief in the form of lower oil prices as we tie up this whole Iran situation, I think, we'll probably overshoot to the downside and then start to move our way back higher. And I just would note that the price of oil was up $10 year to date before February 27th when we went into Iran. So the price was moving up, same with gasoline prices. So I think the path for energy in general is higher, although this clearly has, created some real volatility in the near term.
Mark.
Stephanie, question for you, staying on the gasoline price topic. There's been a lot of conversation about $4 a gallon gas. When do we get back down to $3 a gallon? Obviously, that's important for consumer spending. And, when you go through the bank earnings that we've had over the course of the last few weeks, it seems like the higher income consumer is incredibly strong. But Wells Fargo informed us that the lower income consumer was feeling a little bit of a pinch from the prices at the pump. I'm wondering how you think this is going to play out, assuming we're able to reach a deal. Are we going to be able to get gas prices low enough again to alleviate some of the pressure on the lower income consumer?
Well, as you know, the gasoline prices take a lot longer to come down than the price of oil. So
no doubt.
That tends to be a problem. And obviously, with the midterms rapidly approaching, this is the number one question in terms of the Republicans winning that affordability argument. At the end of the day, the affordability argument will turn on that price of gasoline. So I think it's really crucial. As to the low end, they've been struggling for a while. The one thing that has helped sort of mitigate that pressure with this increase in gasoline prices has been the tax refunds. So this is one area where I get a little concerned with people extrapolating the strength in the consumer we're seeing now, and we're going to get a retail sales number in a little bit here that should look strong as well, as indicative of this fundamental strength of the consumer, when a lot of it is really being driven by the tax refunds, which have been significant enough to give those lower and middle income households the wherewithal to both absorb the increase in gasoline prices and sustain their spending. There was even an article on Bloomberg the other day suggesting a lot of homeowners consumers where they can, were using the refunds to help pay down some of their debt. But once the refund season ends, then the whole game changes and becomes much more challenging, and everything will turn from there on wages and the extent to which they can outpace inflation. And I would note, it was universally derided, but that University of Michigan survey hitting a record low is a very important reading, not because it hit a record low. It just continued a trend that's been in place for years now. And for years, everyone has poo-pooed it and said, consumers are just parroting back what they're hearing on the news. But I think it bespeaks a reality in the labor data, that we're not getting an accurate, whatever the quantity of jobs that are being produced may be, the quality is clearly lacking. And you see that reflected in the consumer's outlook for his real wage expectations, which are the lowest on record. They're lowest even than they were during the peak of the Biden inflation at 9.2%.
Yeah.
Inflation is 2.5%, so it has to be the wage side of it that has consumers so disheartened.
And yet, the major banks so far, better than expected earnings for the first quarter. We heard from J.P. Morgan, Bank of America, Citigroup, all pointing towards stable borrowing, solid balance sheets, improving trends on delinquency. They highlighted resilient consumer spending, actually, with support from the higher tax refunds. I guess the average refund, Liz Peek, is around $3,500, so it is a big number. Jump in here. They did warn of risks of the potential credit cycle. However, that, too, was called sort of lower than people thought. Liz, jump in.
Yeah, Stephanie, I think you're right that the tax refunds, which Maria points out are better than expected and higher than last year, have been fueling consumer spending. But actually, if you look at things like credit card receipts and so forth that the Bank of America puts out, it's actually been above expectations for months. It's not just during tax refund season that the consumer has continually surprised on the upside. So, you know, I think the data they're showing us about spending and about income and wages still is pretty good. So hopefully that doesn't, to your point, kind of get totally smashed by higher oil prices and higher gasoline prices. Certainly there's a tension there.
Yeah, absolutely. And I guess I would go through and strip out what are people spending on. You know, we've seen a
I think it's more
situation
services
where
than goods.
the headline consumption numbers, and a lot of it is non-discretionary stuff. You know, healthcare, insurance has been a big
That's
one.
right.
So there are a lot of things that people can't have no choice but to pay money on. And so when you look at these broad spending numbers and say they look good, you've got to really disaggregate whether it's by choice or by need, and then also the degree to which a lot of it reflects higher prices. The retail sales numbers, just as a heads up, which we're going to get, are not adjusted for prices. So if prices are up 10% and sales are up 10%, effectively, you bought the same number of units, you just paid more for the same stuff.
Yeah. All right. We will leave it there. Stephanie, great to get your insight. Thank you. Market is higher,
Thanks.
up 295 on the Dow. We'll see you soon, Stephanie. It is AI week here in Mornings with Maria. We will be right back with the President's Council of Advisors on Science and Technology co-chairman David Sachs, live right here on AI, the intelligence revolution. You're watching Mornings with Maria, live on Fox Business. Stay with us.